Hello, everyone. Today on the Final Bar, it's Tuesday, August 9th. We'll be chatting with Ari Wald from Oppenheimer. We'll get his take on why the S&P may see some further upside from these levels. We'll talk about the overall conditions and how this change of character potentially has evolved for stocks. We'll also key in on that 4150 to 4200 range, which we've been talking about. The S&P, the Nasdaq pulling back today, the Nasdaq down over 1%. But again, sort of short-term chopping around here. The question remains, what's next? Ladies and gentlemen, this is the Final Bar. Hey, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in these markets using the power of stock charts, using data visualization techniques, the technical analysis toolkit, the best practices of technical analysis to understand the markets around us as investors. And to be honest with you, I've often described that your goal as an investor should be threefold: identify trends, follow trends, and anticipate when those trends are reversed. And I think in 2022, you've had opportunities to do all three of those. Right now, we're in sort of that really interesting inflection point kind of move, right? We've certainly rallied over the last 6 to 8 weeks off of the low in June. You've seen a lot of strength with a lot of individual names able to break above their June highs, like Apple and Microsoft, some of the growth areas of the market. Now we're getting an interesting week after last week, which was a lot of choppiness, one big day on Wednesday. This week, a little more of a give back here in the last couple of days, but cyclical areas of the market, sort of sectors like energy, bouncing up a little bit. Financials up today. Utilities and real estate, which are really more defensive sectors, actually doing just fine, while the growth sectors are at the bottom of the return list. One day does not make a trend, but a series of days strung together is how trends actually play out. So let's focus on what happened today, but connect it to what we're seeing in the bigger picture. I'm really excited to talk to Ari Wald from Oppenheimer. Is one of the best that we can bring on the channel to see what sort of charts are top of mind for him. Rest of this week, pretty solid. Wednesday, we have JC O'Hara from MKM Partners. And then on Thursday, the 11th, Mark Newton from Fundstrat Global Advisors. Also, as a reminder, we have a lot of great content, a lot of great interviews and commentary for you all on our website, StockChartsTV.com. So if you miss any of our great discussions and you want to review comments from our guests, just check out that website. Let's continue on today's show with our market recap. Let's focus on how these markets have evolved, and particularly how today fits into the big picture. First, however, we have a poll to share with you. We asked you recently, what is the seasonally strongest? And then really, we asked you, what is the seasonally weakest part of the year? What 6-month period, according to the seasonality trends we can follow, what's the weakest 6 month of the period? And we gave you 4 different options. Many of you, 84% of you, very correctly keyed in on the sell in May and go away thesis, which is driven by the reality that May through October tends to be a lot weaker. If you look at that 6-month period, the returns May through October far underperform the returns in the other 6 months from November of every year to April of the next year. As a matter of fact, Sam Stovall, whose work we quote often, really a pioneer in sector rotation, really promoted this idea of growth versus value and cyclical versus defensive rotations during the calendar year, has an ETF that is driven by that methodology, driven by that May through October weakening period, and how it often pays to be defensive there. It's interesting to see that in certain years, and really in the last couple of years, May through October has actually been fairly strong, right? 2021, not bad. 2020, pretty decent as well. So 2022 could be an interesting different version of that. We'll have to see where things go from here. By the way, we have a whole series of seasonality charts that you can track at the top of our website. If you switch where it says Sharp Chart and go to seasonality, you can actually look at seasonal trends on any chart that you like. Let's continue on with our market recap. The S&P closing around 4122. That's down about 0.4% from yesterday's close. The Nasdaq 100 down just over 1%, closing just above 13,000. The VIX pushing back to the upside. And actually, I was recording a video earlier today, which will air in the coming weeks on StockCharts TV, relating the VIX to the S&P 500, thinking about that relationship between volatility and the S&P. And long story short, in 2022, the VIX nearing sort of 20 has often coincided with market tops. We'll see if that plays out, because the VIX has been coming down since that June bottom that we saw in the markets. Looking elsewhere, interest rates pushing a little bit higher, with 10-year yield around 280 and long bond yields remaining just above 3%. The dollar index not too much different from yesterday, and that stronger dollar environment over the last 12 months has been a key story, particularly in 2022. Any change in that thesis really gives room for risk assets to appreciate. And that's what we've seen since June as the dollar index has come off a bit. A little bit of mixed results in commodities, although the broader commodity complex, the DBC ETF, which we track, was up about 0.8%, and a lot of red on the charts of cryptocurrencies. Now, a number of these have recovered kind of nicely in the last week or so. Bitcoin getting above 23,000, Ether getting above 1,700, both pulling back a bit today, with Bitcoin down about 3% to just around 23,100, and Ether back below 1,700 just before we went live with the show here at 4 p.m. Eastern. Let's look at a daily chart of the S&P 500s to check in on how that is looking. When I mentioned, the importance of price resistance, this is the chart, one of the charts that come to mind. And as I was recording a video earlier today talking about the importance of support and resistance levels, this was literally the example that we talked about, because it's so timely and so and so important as an illustration of the value of resistance levels. One of the things we noted back here in March was the rally off of the lows in February, the higher low in March, and then the rally to right around 4,600. We closed above there for one day, and that felt like the S&P was going to go to 5,000. It felt like the recovery was in. We were going to continue to go to the moon. Everything improves, the momentum starts to improve, and that was pretty much it. We stalled out right at that resistance level. So now looking back, you can see how it was really essentially a test of 4,600 that failed, and then the market kind of rolled over afterwards. We are at a very similar point here, and this is why that 4,200 level has been an important one that we've talked about. So far now in the last couple of days, we've pulled back a little bit. Early over the last week, we've pulled back after we got above 4,150. This is why, looking at this chart, getting above 4,200 and staying there really changes the character of this market. Then it's no longer a testing previous resistance and failing. This would be the market that actually is able to power through previous resistance levels. That would indicate that buyers are optimistic and are willing to pay a little bit more than they have been over the last couple of months. That is, I think, what would propel or could propel the market to new highs, or at least to new swing highs. So momentum, very similar to what we saw in late March. Price facing resistance, very similar. Question mark is whether we can power through through that level or not. Now, one of the interesting things as we're thinking about price performance is looking at some of the other confirmational information, like breadth, right? So market breadth is a way of looking at participation. So the index is doing one thing. What about all the stocks that comprise those indexes? Here's the S&P 500. Now, this is the same chart, but on a closing basis, so it looks a little bit different. But you can see that the close here around 4175, 4180, I think, in early June, and we're sort of testing, we're getting near to those levels currently. Look at the advanced decline lines for these four different groups. Here's the New York Stock Exchange, broad equity universe in the US, and then we have large caps, mid caps, small caps. And I should note, this is not updated for today's close just yet. This is as of yesterday's close, Monday's close. If you look, the New York Stock Exchange 80 line has not made it above its June high. Same can be said for the large cap breadth, which is not as well. The mid cap 80 line actually just broke to a new swing high yesterday. The small cap 80 line actually made a new swing high last week. So you're starting to see breadth conditions improve, and you're starting to see some of these 80 lines break above their swing highs. The most important one, in my opinion, is that 80 line at the top. That's the New York Stock Exchange, which is a pretty broad group. It covers a lot of sectors, a lot of different themes. That gets above the June high while the S&P eclipses 4,200. I maintain it would be very difficult to remain bearish given that sort of evidence, if you would see that sort of upside follow through from stocks. I did want to highlight one other chart here as we wrap up, or maybe a chart or two as we wrap up our market recap. And this is looking at the relative performance of consumer discretionary versus consumer staples. This is one of my favorite ways to think about offense versus defense. You're looking at essentially two sectors, but you're looking at a broader consumer space and seeing if investors are rotating more to the things you want or more to the things you need. If we're going to more of the things we want, consumer discretionary, that's more of a risk-on play. If you're rotating more to things we need, that's more of a defensive play, right? Things that would ride out periods of market uncertainty. If you look at the cap-weighted version of this ratio, which is the XLY over the XLP, it's made a new swing high. It broke above that high from early June. So while the S&P is testing that high, this ratio is actually already powered through there. What's interesting is though is that's the cap-weighted ratio, right? So the XLY is dominated by three stocks, or the discretionary sector on a cap-weighted basis. It's Tesla, Home Depot, and Amazon is the largest one. So while those three names and the strength there has really powered that ratio higher, the equal weighted version has not quite broken above the June high. So as I'm thinking about how to validate a potential break above the 4,200 level, as I'm looking for evidence besides just the price, the value of the S&P and individual stocks, looking at some of these breadth conditions and offense versus defense shows me some very clear levels I think we need to break. I would argue we haven't quite done that yet. Just to finish off before we take a brief break, as a reminder on the sector basis, energy, the top one today, yesterday as well, if I remember right, which you're seeing a nice bounce on charts like DVN and FANG and some of the other E&P stocks and others having a decent bounce after being relatively weak and underperforming growth areas of the market. The growth stuff at the bottom of the list today. When we come back from the break, we'll talk to today's guest, Ari Wald, on what he thinks about some of this evidence and what levels he'll be looking forward to. We'll see you back here in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you so much joining us every weekday after the close for our show as we break down the activity in the markets and share the best practices of technical analysis. We have a really good guest here in a few moments, Ari Wald from Oppenheimer. Before we get there, a couple quick announcements for you. First off, we welcome your questions. We're going to do a mailbag segment a little later in today's show. And our next mailbag in Friday's show, we'd love to feature you live on the air. Our email is the Final Bar at StockCharts.com. We are on Twitter at Final Bar SCTV, and we're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll gather all those questions and hope to answer one of yours live on the air on Friday's show. Also, go to StockChartsTV.com. That is our on-demand platform. There's so much fantastic content for free every trading day. Larry Williams just posted a market outlook last week. We had Martin Pring a couple weeks ago with his mid-year market outlook. Our StockCharts mid-year market outlook called Charting the Second Half, our latest episode of The Pitch, which aired on Friday. There's so much great content to help nudge your thinking, help reinforce what you are seeing in your own charts. All of that is available at StockChartsTV.com or on your mobile device. Just search for StockCharts TV on demand. I want to welcome on today's guest, Ari Wald. Ari is the head of technical analysis at Oppenheimer, joining us from New York. Ari, it's great to see you. Thanks for coming back on the show today.
Hey, always a pleasure, Dave. Thanks for having me back.
It's good to see you. We're bringing up your first chart here. It's obviously been a fascinating experience watching this sort of change of character as I talk about it, right? Sort of plunging lower into June and then all of a sudden reverting back to the upside. Your first chart tries to address that. Talk us through what you're seeing here.
Yeah, I think the behavior of the market has changed. And, you know, listen, there could be some near-term give back. I think some base building, but our message to clients, Dave, is to stay the course. That our view is that a larger market recovery is developing. And the reason why is the action in interest rates. First off, if we think about that first half drop down 25% over a 5-month period, it was really driven by, our take was this runaway inflationary fears and what was this risk-off rise in the 10-year U.S. Treasury yield, which pressured high valuation stocks as represented by the Nasdaq, which was a key laggard on the downside. So the action here changed in June. Specifically, you had a failed breakout in that 10-year at the 2018 peak of 3.25%. You had to move above it, couldn't be sustained, and followed by some subsequent moderation. And that triggered the rally that we've seen in the Nasdaq and the markets overall. So that's the line of demarcation for us. As long as the 10-year is below 3.25%, we think a key market risk has been removed. We think it's allowing high growth stocks to find their footing. And in turn, we think it's allowing the equity market to bottom. Conversely, a breakout above 3.25 would force us to revisit our view. But we're below it. We're following the presidential cycle also, which suggests should be some base building in the third quarter, followed by what we expect to be an upturn in the cycle when seasonals improve in the fourth quarter.
Yeah, I'm so glad you mentioned the seasonality component as well, right? In this sort of year, usually you'd expect third quarter to fourth quarter, especially, tends to be fairly constructive. We may be setting up for that. Your second chart, by the way, is looking at one particular area, a more defensive area of the market. Can you talk us through this one?
Sure. It speaks to the key positive. And I think also I heard you lead in with the similarities to the late March rally. The key difference is that this time around, the market is coming off a washed out condition, full capitulation, stocks across the board selling off. And again, consistent with what we think is a garden variety bear market low. There's a few ways to measure this. First, you had only 14% of NYSE stocks above their 200-day average at the lowest point. And again, it was across the board, including your counter-cyclical defensives, your safe havens. The bear cycle even came for the leaders at that final drop. So consider this S&P low volatility ETF. It typically outperforms in a bear market by falling less. So it did outperform. It was coming off a multi-year relative high in June, but still fell 10% below its 200-day average. And what we're showing in the chart is we tried to signal each time this index fell at least 10% below its 200-day, and that's an extreme reading. It's all, we're looking at data since 1980. Generally, that type of extreme occurs at a market opportunity, again, making the case that we saw capitulation in June. Now we've seen the turn in the market. These conditions can always become more extreme, but again, the weight of the evidence, how we see it, again, argues for the base and the longer term recovery that we think is occurring.
That's a great chart, Ari, to show where we were there in June relative to some of these really, pivotal market bottoms. And again, if you look back, if you could buy at each of those levels, you'd probably be pretty encouraged by that opportunity. So we only have about a minute left there, but when you're looking at the market now, if it is more of a constructive environment, if this is a bottoming pattern with upside potential through year end, where do you look for opportunities? Is it, growth areas of the market pulling back a little bit this week, but overall showing some renewed strength out of June? Or is it places like energy, right, that had really good runs and have pulled back quite a bit after their runs earlier in the year? Where are you looking opportunistically now?
Well, our top three sectors are tech, healthcare, and energy. I think energy is a good diversifier. It's really been uncorrelated to a lot of these other sectors. But to answer your question specifically, we do expect it to be a growth-led recovery driven by the likes of technology and healthcare. Some of the bear market's biggest laggards. What we found is start of a new bull, you tend to get a rotation into prior low momentum areas of the market. And I think the macro trends support that. I think what's giving a lot of investors trouble is that you have an equity market bottom at the same time that long duration bond yields are moderating and topping out. So it's not your typical early cycle turn. It looks more late cycle to us with a flattening, the market still having to deal with a flattening yield curve and leading economic indicators that are still pointed lower and haven't fully reset. So I think we get back to one of these points where the scarcity premium again gets put on these high growth companies in this low growth backdrop. And you're seeing the action. These software stocks are absolutely ripping off of some really depleted conditions. I think that turn in growth and software continues.
It's such a great take, Ari. Listen, thanks for sharing some charts with us. Thank you for being such a great advocate for technical analysis in the industry. And be safe there in New York. We'll talk to you again soon, all right?
Hey, thanks, Dave. I'll talk to you soon. Take care. Bye.
That's Ari Wald. Ari is the head of technical analysis at Oppenheimer in New York. I love the way he described that. And again, a much more constructive outlook to the investment environment than I've been portraying for sure. And Ari and I got to talk a little bit before we went live today. His comments make a lot of sense. When you think about what I always try to identify what you call a change of character. When conditions have been a certain set, And then all of a sudden that changes, right? And recognizing those inflection points, not necessarily on the day or on the moment they happen, but seeing the change, the sea change when things really start to evolve in a lot of ways is the game. And his charts, Ari's charts today, certainly making me think overall about positioning and how to approach this market. Great take there from Ari Wald at Oppenheimer. Let's continue on our show today and go to the Final Bar mailbag. As a reminder, we're here for your questions. The Final Bar at StockCharts.com, and let's get to question number one. Dave, I've been using the RRG capability on StockCharts and wondered what the picture would look like using a basis other than SPY, such as RSP or $1. How do you read these? And if you're not familiar, everyone, by the way, the RSP is an equal weighted S&P ETF. $1 basically just shows you the RRG, the relative rotation graph, on an absolute basis. It's not showing a relative benchmark. It basically turns it into a rotation based on the absolute price movements. So when you bring up the RRG, and I always start with the sector RRG, that's my go-to, and I look at this multiple times a day, most of the time, and it's showing the 11 S&P sectors relative to the S&P, and the S&P basically is at the crosshairs, and you're looking at where these sectors rotate around the benchmark. What you're asking about is looking at the equal weighted version, which is basically looking at sectors versus the RSP, which is an equal weighted benchmark. So a couple answers to your question. Number one, I love the way that you're thinking a little bit outside the box, right? Just the RRG with the regular settings, I think can tell you a lot. But if you really want to understand the dynamics, when I talk with Julius de Kempener, we rarely stay just there. We're always bringing up the equal weighted version, the absolute version, looking at particular sectors and groups and how they're rotating versus the underlying sectors and versus the broader market. There's so much that this can do to help you really understand where assets are rotating around the equity complex and even outside of there. So first thing I would say is if you are going to use a benchmark of the RSP, you probably want to use equal weighted ETFs as well. So when you go to where it says groups, if you change it to EW, which is equal weighted, you'll find the benchmark changes to the RSP, but you're also looking at the equal weighted sector ETFs. And I would encourage you to do that. Otherwise, you're doing kind of an apples to oranges thing, and you're going to get some weird results based more on the fact that you're equal weighting some of it and you're cap weighting other parts of it. And it's kind of a weird, incompatible relationship, in my opinion. The equal weighted sectors versus the equal weighted benchmark, a lot of times will help you capture things. In a lot of ways, an example of that is with consumer discretionary. I often refer to that, but even technology is dominated by a couple mega cap names, Microsoft and Apple. So by equal weighting it, you're looking more at the broader groups, the broader sectors, the individual stocks, and how they're rotating around an equal weighted benchmark. Now, when you do $1, you're going to do a really cool thing. And I'll go back to the cap weighted ETFs and I'll change the benchmark to $1. What this is now doing is instead of looking at the relative performance, it's just looking at the absolute returns. And when my guest today, Ari Wald, is talking about the broad recovery and how things are bouncing off of their June lows, this is what the RRG is showing you here using weekly data. Almost all of the sectors, I think 7 out of 11, are in the improving quadrant today based on the weekly data. And it's all over the place. It's offense, defense, it's a little of everything. Now, a lot of the defensive stuff like staples and utilities are actually down here. Energy is definitely the outlier, rotating lower on an absolute basis. And again, this isn't reflecting necessarily the bounce of the last couple of days, but more the last couple of weeks that have been pretty weak. So by changing that to $1, that will help you understand the overall rotation of these stocks just on an absolute basis. Where are you seeing the price opportunity? So ideally, you look at all three of these. You start to see the cap-weighted relative performance, the equal-weighted relative performance, see if there's just a small number of names that are really influencing particular stocks. And then $1 allows you to do it relative to nothing, basically just on the absolute basis. I look at all three of those, make notes on what you're seeing, and then you're going to have a much better understanding all across the table. Great question there, and thanks for highlighting a really cool feature of the RRG charts. Next question, what is a commodity super cycle? I heard this for 6 months I love this question. I heard this for 6 months while oil was going up, that we were in a super cycle and energy stocks were going to be going up for years. Now I hear no one mentioning it. So I think one of the things and thank you so much for that question. I think one of those things that you're finding is basically just the challenge of being a market practitioner, and particularly a market strategist that's a so-called talking head. It is great to be talking up a sector or a theme when it is working dramatically. When it stops working, you tend to see people get a little more quiet because there's a question mark by it. We like to make noise about things we have high confidence on. When things get a little low confidence, which happens a lot more than we would probably imply, you probably want to be a little quieter on because you're a little unclear as to what the next direction may be. I would argue that larger super cycle, a super cycle is not a couple days or a couple weeks. This is a multi-month, if not much longer rotation away from certain themes and into certain themes. And I would argue that we probably haven't seen the end of a move higher in energy and commodities. We're talking a lot less about it recently because you've seen such a bounce in things like growth, particularly since the June low. You've seen energy rotate lower, and it's been much more about the growth theme. That your question right there, by the way, is why I asked Ari particularly about energy. And I think if you heard him right, he said it's three sectors that he liked were technology, healthcare, and energy. So interesting that he likes a growth-oriented sector like energy, like technology and even healthcare, right? Sort of traditional offense, but also energy because it's a good long-term chart that's pulled back so much. And a lot of times that's a really good opportunity to get into a particular space that you may have been less familiar with. So having said that, I think it's very much still in play. It's a little out of vogue to talk about it because energy's pulled back so much. But remember, the game is not won on short-term themes, which is what we often have to talk about on financial television. It's more about the long-term cycle. That's why I think the commodity super cycle is still very much a possibility and likely. Final question for just a moment. How can we monitor the width of high yield spreads on the StockCharts platform? It seems to be an interesting concept right now. I 100% agree. On my Mindful Investor Live chart list, one of the charts that I have, if I can find it, here we go, is high yield spreads. And there are a couple different ways we can do this. I like to use an index called the high yield OAS spread. It's $, HYIOAS. Don't even worry too much about what that means. Long story short, this is a spread. Option adjusted spread just means you basically exercise all the options that are embedded in the bonds. And essentially, the higher this value, the wider the spread. The wider the spread, the more risk or the more premium that bond investors are requiring to accept the risk from these risky companies, from these junk bonds. So if the spread widens, that tells you bonds are riskier and the spreads are widening. It's more of a premium that they need. When the spreads are narrowing, it's more of a risk-off environment because things are good and they don't need to worry too much about it. I chart this inverted, just like the VIX inverted, because that matches pretty well with the S&P 500. When this chart is going higher, that means the spreads are narrowing. It means volatility is decreasing. That means it's a risk-off environment for stocks. If the high yield spreads are widening, it's going lower on this chart. If volatility is increasing, that's going lower, and that usually lines up with the S&P going lower. So check out my Mindful Investor Live chart list for that chart among many. We need to wrap the show quick, folks, and go to the 3 in 3. Let's talk about 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. I love talking with Ari Wald from Oppenheimer. He's one of my favorite strategists. I've known him for many, many years and enjoyed so much watching him grow and to be one of the top analysts on the street. And he really deserves that recognition. One of the things we talked about was just the overall strength that he is seeing in stocks and the potential for upside from here. What I would tell you is I totally get that idea if we get confirmation from Brett. This is one of the charts that I've been following. Before, these were all red. Now you can see 2 of them are neutral orange. 2 of them are positive green because we've broken above the June highs. The S&P has not gotten above 4,200 yet, but some of the breadth indications that I'm following are certainly backing up the bullish thesis. I think that's a key chart to watch, particularly if the NYSE advanced decline line can make it above its own June high. Chart number 2, one of my questions was on high yield spreads. It's a really interesting part of the market. A lot of traditional individual investors are not familiar with fixed income, and I would encourage you to build your expertise in that area if you're underexposed to it, because institutional money managers I've worked with know a lot about fixed income because it tends to lead the equity markets. High yield spreads overall have been narrowing over the last 6 weeks. That lines up with the reduction in volatility, and that has lined up very well with a spike in stocks. This is a really good chart to watch going forward to see if those conditions might change. Finally, MPC. I like the fact that energy stocks have rallied, many of them off their 200-day moving average. DVN, FANG, we've highlighted today. I want to highlight MPC, which is one of the top performing stocks today in the S&P 500, up over 3%, while the S&P is nowhere near that. I like the recovery in energy. Can the momentum improve from here? And can the RSI get above 60? That would be my question for the chart of MPC. Folks, that's a wrap for the show. I want to thank Ari Wald from Oppenheimer, sharing some great thoughts from New York. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.